Something shifted in the last 24 hours that most people watching the markets right now are completely missing. Not because the information isn't out there, but because the people who are supposed to be explaining it to you are either not paying close enough attention, or they're too focused on telling you a story that fits a narrative rather than one that fits the data. Gold just bounced nearly a full percent off its weekly lows. Silver clawed back more than 2% after getting hammered with a 5% drop the session before. And the mainstream financial press is out here calling it a simple relief rally. A bounce, business as usual. They are wrong, and by the time you finish watching this, you'll understand exactly why, and more importantly, what you should actually be watching for over the next 48 hours, because the real moves haven't happened yet. If you've been around long enough to remember 2008 or even the volatility of 2020, you know what it feels like when the market is telegraphing something that most people won't see until it's already happened. That feeling is back. And if you're someone who actually cares about your financial future, rather than just watching numbers go up and down on a screen, you're in the right place. Hit that subscribe button right now if you haven't already. At Element Axis, we don't do hype. We don't manufacture fear to keep you clicking. We follow the data, we check the sources, and we break it down in plain language so you can make informed decisions for yourself. That's the commitment, and it's not changing. Now let's get into what actually matters here, because there's a lot to unpack, and the clock is ticking on some genuinely significant market events. Gold spot price is sitting at approximately $4,320 per ounce, after recovering about 0.91% from what was a brutal session on Tuesday. U.S. gold futures for April delivery settled just under $4,950, up roughly 0.89% on the day. Now those two numbers might seem close enough that you'd say they're basically the same thing, but the difference between spot and futures pricing is something that tells you a lot about how the professional market is thinking about the near-term direction of this metal. When futures are pricing a meaningful premium above spot, it's a signal that the smart money is paying up for future delivery. They're not just reacting to today's price, they're locking in exposure because they believe prices will be higher when those contracts settle. For those of you who pay attention to regional gold markets, the UAE numbers are worth noting too. 24 karat gold moved up 3.75 dirhams to settle at 594.50. 22 karat climbed 350 to reach 550. 21 karat hit 528. 18 karat moved to 452.50, and 14 karat ended at 353 dirhams. I know some of you watching have family or financial interests tied to Middle Eastern markets specifically, so I want to make sure you're getting the full picture, not just the headline number that everyone else is throwing around. But here's what I really want you to sit with before we go further. Silver is where the most interesting action happened, and silver is where the most important story is developing right now. Spot silver jumped 2.43% to 75.59 after that brutal 5% decline the session before. Platinum gained 2.05% to reach $1,245. Palladium climbed 2.4% to $1,500. The entire precious metals complex moved higher together. And that coordinated recovery behavior is exactly what we need to be asking questions about. Why did they all drop together? Why are they all recovering together? And is this recovery the beginning of something real or just a dead cat bounce before the next leg down? These are the questions that matter. And I'm going to answer them for you, but I want you to understand the framework first, because if you just give someone a fish, you've fed them for a day. If you help them understand how the fishing works, they can feed themselves forever. That's the goal here, every time. What triggered the sell-off in the first place is something the mainstream financial media isn't discussing openly, and I want to talk about why. This wasn't a situation where gold and silver dropped because something changed in their fundamental supply and demand picture. This wasn't investors suddenly deciding that precious metals aren't worth holding. This was mechanical. It was forced. It was liquidity-driven selling at its most raw and transparent form, and if you know what to look for, it was actually completely readable in real time. And when you see gold drop more than 2% in a single session, while simultaneously watching equity markets experience violent swings in both directions within the same day, you are not watching normal market behavior driven by fundamentals. You're watching the fingerprint of leveraged players getting margin called. You're watching sophisticated investors who are carrying borrowed money in other parts of their portfolio being forced to raise cash fast, and they do that by selling their most liquid positions. Gold and silver, despite being physical commodities with real, tangible, finite supply, trade on paper markets that can move faster than almost anything else when large players need to get out quickly. The paper market is essentially a pressure release valve, and somebody turned that valve extremely hard on Tuesday. Now here's where things get genuinely interesting. The bounce we're seeing now is not retail investors buying the dip. When you look at where the buying actually started and how it behaved, The institutional footprint tells a very different story than what you'd see if this were just individual investors seeing a sale and clicking the buy button. Reports indicate that large institutional investors began accumulating heavily when silver approached the $73 level. And the crucial word here is not buying. The crucial word is accumulating, specifically as a long-term entry point, not a trade, an entry point. Because those are two completely different things. A trader buying at 73 might flip that position in a week or two if the price moves 10% in their favor. An investor taking a long-term entry point at 73 is positioning for a move that could take 6 months, 12 months, or even longer to fully play out. When institutional money enters at technically significant support levels during periods of maximum retail fear, you're watching something that has a name in markets. It's called the wealth transfer mechanism. Weak hands selling to strong hands. Emotional reactive participants getting out while disciplined, patient participants get in. This is how it works every single cycle. And recognizing it while it's happening rather than after the fact is what separates the people who build wealth from the people who always feel like they missed it. Let me walk you through the technical structure of silver right now because this is directly relevant to how you think about risk and opportunity in the coming days. Silver found key support at 72.86, which aligns very closely with the 72.19 horizontal support level that has been tested multiple times going back several months. When you have two or more technical factors pointing to the same price area, traders call that a confluence zone. And confluence zones are important because they represent areas where large players have essentially drawn their line in the sand. The $72 to $73 range is that line for silver right now. Here's the thing that non-technical investors sometimes struggle to appreciate. Price memory is real. This isn't mystical or abstract. Institutions remember where they built positions. Algorithms have that data embedded in their logic. The market itself carries a memory of where high volume activity occurred, and that memory influences behavior at those levels in the future. The recovery bounce we watched began precisely at this confluence zone. Not close to it, not roughly near it, at it. That's not coincidence. That's the market functioning exactly as you'd expect it to when you understand the underlying mechanics. On the resistance side, immediate resistance for silver sits at 78.73, which aligns with the descending trend line coming down from recent highs. Above that, the 50-period exponential moving average sits around 79.46, acting as a dynamic ceiling for any near-term relief rally. Think of that moving average as a floating roof. Prices can push up toward it, but breaking through it cleanly and holding above it takes real conviction, and usually requires a meaningful catalyst. The major resistance level that would signal a genuine resumption of the larger upward trend for silver sits at 82.45. A decisive break above that level, meaning a close above it on meaningful volume, opens the path toward $90 and potentially beyond. But that's not where we are right now. What we're watching right now is whether this recovery can prove itself by reclaiming those lower resistance levels with some staying power. Touching them and getting rejected doesn't count. The market needs to absorb selling at those levels and push through. For gold, the critical support zone sits between $4,800 and $4,900. Gold is currently trying to hold above this range. If it loses that zone on a closing basis, the next meaningful support sits between $4,670 and $4,690. On the upside, $5,000 is the psychological gateway number. Above that, the $4,800 to $5,000 and $100 to $5,200 range has been tested multiple times and shown its strength as resistance. Most market observers believe gold will need a significant catalyst to push convincingly above that 5,200 level. But significant catalysts have a way of appearing when the underlying fundamentals are as strong as they currently are, which brings me to what I think is the most important part of this entire conversation. The next 48 hours are loaded with potential market-moving events that traders and investors across every asset class are positioning for right now, in real time. Two specific data releases are going to dominate the conversation and could meaningfully shift where precious metals go from here. The first is the Federal Open Market Committee minutes from the January meeting. These are released today. This document is going to be read word by word, sentence by sentence, by every institutional trading desk that matters. They're not looking for the headline. They're looking for shifts in tone. They're looking for language that suggests the committee is moving toward cutting rates faster or slower than what current market expectations imply. According to the CME's FedWatch tool, current market expectations are pricing in a rate cut around June. Any language in today's minutes that either accelerates or pushes back that timeline is going to move precious metals immediately. This is not a situation where you get to think about it overnight. The reaction will be fast. And let me explain why the rate timeline matters so much for gold and silver, because some of you watching might be newer to this and deserving of a clear explanation rather than just an assumption that everyone already gets it. Gold and silver don't pay you interest. They don't have a dividend. They don't generate cash flow. When you hold physical gold or silver, the only return you get is price appreciation. That's it. So when you compare holding precious metals against something like a money market fund that's currently paying 5% with essentially zero risk, the math starts working against metals. That gap, that opportunity cost of holding non-yielding assets in a high-rate environment is real, and it suppresses institutional demand for gold and silver. When rates start coming down, that opportunity cost shrinks. A capital that was perfectly happy sitting in treasuries and money markets starts looking for assets with more upside potential. Hard assets, real assets, metals, these start attracting that capital rotation. This is why the rate cut timeline isn't just a political or economic story. It's a direct driver of precious metals, price action through actual portfolio allocation decisions involving trillions of dollars of institutional money. If you've got people in your life who are trying to understand why precious metals prices respond so dramatically to Federal Reserve decisions, share this with them. Drop this video link to someone who needs to see this explained clearly. It helps us reach more people who are serious about this stuff, and it helps that person understand something genuinely important about how markets actually work. The second major data release coming is the Personal Consumption Expenditures Report for December. This drops on Friday. PCE is the Federal Reserve's preferred inflation gauge. Not CPI, not the number you usually see making headlines. PCE. The Fed has been explicit about this. When they make policy decisions, PCE is what they're watching most closely. If PCE comes in hot, meaning higher than expected, rate cut expectations get pushed back further into the year. The dollar strengthens. Precious metals face headwinds in the short term because the math of portfolio allocation shifts back against them. If PCE comes in soft or right in line with expectations, it validates the disinflation story that the market has been building its rate cut expectations around. That keeps or accelerates rate cut pricing, and precious metals catch a bid. Two massive data points in rapid succession. A market that's already showing signs of stress and dislocation, elevated volatility, uncertainty running high. This is exactly the setup where price moves get amplified. Volatility doesn't come from nowhere. It comes from uncertainty meeting a catalyst. Right now, we have both. Understanding that dynamic is what allows you to make sense of what happens when those numbers drop, rather than just reacting emotionally to the headlines. And speaking of uncertainty, the Federal Reserve's own officials are publicly disagreeing about the path forward in ways that are quite significant. One regional Fed president noted that the central bank might authorize several more rate cuts this year if inflation continues moving toward the 2% target. A Fed governor separately suggested that a rate reduction might not happen for quite some time, citing persistent risks to inflation. These aren't minor differences in phrasing. These are fundamentally different views on what appropriate monetary policy looks like right now. When FOMC members are publicly splitting like this, the minutes from their most recent meeting become even more consequential because they pull back the curtain on where that internal debate actually stands beyond the carefully managed public statements. The market is going to learn something today about where the Fed's internal consensus actually is, and that's going to move assets. Now I want to shift gears and talk about something that serious silver investors need to be paying close attention to, because it's flashing a signal that deserves honest discussion even if it's not the most comfortable conversation. The gold to silver ratio has climbed above 66 and continues moving higher. For anyone who isn't familiar with this metric, it's straightforward. I want to take a minute to address the geopolitical factors, because I see a lot of analysis that either completely ignores them or treats them as the only thing that matters. The truth, as it often is, sits somewhere more nuanced. There have been reported developments in diplomatic discussions around Iran's nuclear program. Iranian officials have clarified that while there's been some progress in establishing guiding principles, a deal is nowhere near imminent, and significant work remains. Additionally, the first round of peace discussions between Russia and Ukraine recently concluded in Geneva, with significant involvement from American diplomatic pressure. Now these two situations matter for precious metals because gold in particular carries what traders call a geopolitical premium. When tension rises in key regions of the world, capital flows into gold as a hedge against uncertainty. When tension appears to ease, that premium compresses. Part of what happened in Tuesday's sell-off can be attributed to some of that geopolitical premium coming out of gold, as headlines suggested diplomatic progress on multiple fronts. But here's what experienced precious metals investors know from watching these situations play out over many cycles. Geopolitical situations almost never resolve cleanly or quickly. Progress in one area creates tension in another. What looks like de-escalation in a headline can reverse within days when the harder details of any negotiation surface. The market right now is pricing hope for resolution, not actual resolution. And hope has a tendency to encounter reality at uncomfortable moments. Drop your thoughts in the comments section. I want to know what you're watching right now. Are you paying more attention to the Fed minutes today, or is the PCE report on Friday the one that's keeping you up at night? The conversation in the comments is genuinely some of the best analysis that gets produced here, because a lot of you have real-world experience, real money in the market, and perspectives that I can't replicate by myself. Don't hold back. Now let me give you the full bear case, because this is something I feel strongly about. You cannot make good decisions in any market if you're only consuming analysis that confirms what you already believe or what you want to be true. The bear case for silver and gold right now deserves an honest hearing. First, dollar strength. The American dollar gained meaningful ground this week as traders responded to weak economic data coming out of Europe and the United Kingdom. A stronger dollar is mechanically bearish for gold and silver because these metals are priced in dollars. When the dollar rises, it takes fewer dollars to buy the same ounce of metal, which pushes the dollar price down, all else being equal. If dollar strength continues, it creates persistent headwinds for precious metals, regardless of how strong the underlying fundamentals look. Second, the data we're about to receive could easily come in hawkish. The FOMC minutes could reveal more disagreement within the Fed than the market is currently pricing, pushing rate cut expectations further out. The PCE data on Friday could come in above expectations, suggesting inflation is stickier than hoped, which would further delay rate cuts and potentially strengthen the dollar. Neither of these scenarios is unlikely. Third, support levels break. That $72 to $73 range that everyone, including myself, has been pointing to as key support is not a guarantee. Technical support is a probability, not a certainty. If that level fails and silver closes meaningfully below it for a sustained period, the next major support sits somewhere in the $64 to $65 range, where lows from earlier in the year were established. That's a significant additional drawdown from current levels. Fourth, the gold to silver ratio expansion I mentioned earlier could continue. If it pushes back toward historical levels near 80, while gold holds relatively steady, the implied silver price is substantially lower than what we're trading at today. Fifth, the geopolitical premium in gold could continue deflating if the diplomatic progress we've seen continues to develop in a positive direction. If both the Iran situation and the Russia-Ukraine negotiations show genuine progress, some of the fear premium that's been embedded in gold prices could come out further. I lay out the bear case, not to scare you, but because I respect your intelligence and your ability to weigh competing scenarios and make your own decisions. The people who lose money in markets are often not the ones who were wrong about direction. They're the ones who were unprepared for the possibility that they might be wrong, and they didn't manage their risk accordingly. Now here's the bull case, and it remains intact despite all of those legitimate concerns I just laid out. The structural supply deficit in silver is entering its 6th consecutive year. 6 years of the world consuming more than it produces. Above-ground inventories are being drawn down year after year. You can suppress the price in paper markets for a period of time, but paper markets must ultimately settle against physical metal. And there is a finite amount of physical metal available. When the gap between paper supply and physical supply becomes too large to ignore, the adjustment happens fast and it happens hard. History is unambiguous on this point. Industrial demand from solar energy, electric vehicles, and artificial intelligence infrastructure is not going away. These are structural long-term demand drivers that will persist through economic cycles. Even if we hit a recession tomorrow, the green energy transition doesn't reverse. The AI infrastructure build-out doesn't stop. The electrical systems that require silver don't get uninstalled. Demand keeps growing. Silver's allocation within global investment portfolios is extraordinarily small. Current estimates suggest it represents about 0.03% of global wealth, compared to approximately 0.06% at the peak of the last major silver bull market in 2011. That's half the allocation level. If even a fraction of the institutional capital that is currently sitting in bonds, equities, and cash decides to increase exposure to silver, the impact on price would be dramatic given how small and relatively illiquid the silver market is compared to those other asset classes. Central bank gold buying continues at historically elevated levels. Monetary authorities around the world, particularly outside the Western Alliance, are actively diversifying their reserve holdings away from dollars and euros and into physical gold. This is a structural, multi-year trend that doesn't reverse quickly. It represents sovereign-level conviction that gold's role as a reserve asset and store of value is not diminishing. And when central banks are your buyers, you have a constituency that doesn't panic sell, doesn't get margin called, and doesn't need to liquidate for liquidity reasons. And here's the framework I really want to leave you with today, because I think it's the most practically valuable thing I can offer. Liquidity events create price dislocations that are temporarily divorced from fundamental value. The sell-off we watched earlier this week was not about silver's supply and demand balance changing in any meaningful way. It was not about gold's monetary role being diminished. It was about leveraged players needing cash, finding the most liquid thing they own, and hitting the sell button. When this happens, price temporarily decouples from value. Assets get sold not because they're worth less, but because someone needs liquidity right now and they don't have a choice about the timing. These moments of forced selling are where patient capital with a clear-eyed view of fundamentals finds its best opportunities. The deleveraging comes first, the opportunity comes after. And understanding that sequence fundamentally changes how you interpret violent price moves. Instead of panicking when you see a 5% drop in a single session, you start asking, who is selling? Why are they selling? And is this selling creating a price that is disconnected from the fundamental value of what I'm looking at? If the answer to that last question is yes, that's your signal to pay very close attention. A few of the most important economic thinkers in modern history have written about this dynamic extensively. The economist Hyman Minsky spent his career documenting how financial instability builds silently during periods of apparent calm and stability. As leverage accumulates beneath the surface across the financial system, the transition from stability to crisis doesn't happen gradually. It happens suddenly. One moment everything looks fine. The next moment forced selling cascades through markets, creating conditions that look completely disconnected from any reasonable view of fundamental value. Charles Kindleberger documented in his landmark work on financial history how these cycles follow remarkably predictable patterns across centuries and across different asset classes. Euphoria and expansion, peak confidence, profit-taking by early movers, then panic as leverage unwinds and forced sellers overwhelm buyers. We may be watching elements of this pattern play out across multiple asset classes simultaneously right now, with precious metals getting caught in the cross-currents of broader liquidity flows rather than moving purely on their own fundamentals. For traders who are actively managing positions, here are the specific levels that matter most over the next 48 hours. For silver, the support zone between $72 and $72.86 is the critical line. You don't want to see daily or weekly candles closing below this range. Wicks below it, meaning brief intraday moves below but then recovering by close, are generally acceptable as they represent short-term liquidity grabs rather than genuine selling pressure. But sustained body closes below that range open the door to a move towards 65 to 67. On the upside, immediate resistance runs from $78 to $79. A decisive break above that zone on elevated volume, meaning the move is confirmed by real participation and not just light holiday trading, signals a potential push toward 82.45 and higher. The $76 level acts as an intermediate checkpoint. If silver can sustain above 76 after the data releases this week, it suggests the bulls have absorbed the selling pressure and are ready to challenge the major resistance zone. For gold, 4,800 to 4,900 is the support line. Losing that on a closing basis opens a path toward 4,670 to 4,690. To the upside, 5,000 is the psychological gateway, and above that, 5,100 to 5,200 has proven its strength as resistance repeatedly. Clearing 5,200 convincingly would be a genuinely significant technical development. For platinum, the $2,000 level is the psychologically important floor. If it fails, support runs from $1,880 to $1,900. Below 1880 opens the path toward February lows closer to 1850. Palladium at $1,500 remains the most volatile of the entire complex. 3% moves in a single session are not unusual for palladium. Position sizing matters enormously with this one. The interconnected nature of these markets is something I want to emphasize because it shapes how you analyze each individual metal. Silver follows gold's directional lead roughly 80% of the time. Gold follows macro liquidity conditions, dollar strength, and real interest rate expectations. The entire complex tends to move together more often than it diverges. Understanding where gold is headed based on macro factors tells you most of what you need to know about silver's probable direction, with silver typically moving with what traders call higher beta, meaning larger percentage moves in both directions. When gold goes up 5%, silver might go up 8 or 10. When gold drops 2%, silver might drop 4 or 5. That beta relationship cuts both ways, and it's important to understand that before sizing into silver positions. Here's where we are as I wrap this up. The market right now is experiencing about as much genuine uncertainty as I've seen in quite a while. The FOMC minutes dropped today, and they could shift the rate cut timeline conversation meaningfully. The PCE data comes Friday with potential to confirm or disrupt the disinflation narrative that's been underpinning rate cut expectations. Geopolitical headlines are shifting daily in multiple directions. Chinese buyers are absent from the market right now due to the holiday calendar. Volatility is elevated, and sentiment has swung to extremes in a short period of time. This exact type of environment is where patient, prepared participants consistently outperform reactive, emotional ones. The data releases coming in the next 2 days will generate volatility. Volatility creates price moves. Price moves create opportunities. But opportunity only matters if you have a framework for understanding what the data actually means, rather than just reacting to whatever the headline number is and whatever the immediate market reaction happens to be. The headline and the real signal are often two different things. If you made it this far, do me a favor and drop something in the comments. Tell me what your read is on the next 48 hours. Are you expecting the FOMC minutes to be dovish or hawkish? Are you watching silver specifically, or is your focus on gold right now? I read the comments, and I respond when I can, and the best conversations always happen down there. Hit the like button if this gave you something to think about that you weren't thinking about before. That signal genuinely helps this analysis reach more people who are looking for this kind of breakdown instead of hype and headlines. The people who understand how markets actually work, not just what the headlines say, but how the underlying mechanics function, make better decisions. And better decisions over time compound into meaningfully better outcomes. That's the whole point of what we do here at Element Axis. Not to tell you what to buy or sell, to give you the data, the context, and the framework so that you can make those decisions yourself with confidence. What you do with it is your call. But you'll make that call with better information than most people watching markets today. Follow the data, verify everything, and stay patient with your process. That's how this works.